My name's Ethan Braid. Today we're going to talk about SPY ETF, the S&P 500, and the likely performance over the next 10 years for long-term investors in SPY. The last decade for SPY has been amazing. Almost 13% compound total return over the last 10 years. I don't believe that the next 10 years are going to see returns that high, and I'm going to give you some reasons why. We're going to start with Warren Buffett's measure of valuation, one of his favorite measures, market cap to GDP, and then move into some other reasons why the S&P 500 is likely to slow down in terms of performance over the next 10 years. This chart is the last 25 years of the S&P 500 market cap to US GDP. What we can see right away is that we are in very expensive territory. 160% market cap to GDP. Long-term average is about 1. And we can see that we are a lot higher now than we were in the last bubble 25 years ago when market cap was 120% of GDP. We can also see that when we get recessionary periods like here in 2008, the market cap to GDP ratio will decline well under 1 like it did by 2009, and that is when stocks are on sale. The beauty of this chart is how simple it is to use. When you look at this chart, it's very easy to determine if stocks are a bargain. Are they cheap like they were in 2009, or are they expensive like they are right now? So now that we know that stocks are expensive by the market cap to GDP valuation basis, let's take a look at some forecasts for the next 10 years to see what seems realistic for returns over the next decade. Over the long run, GDP tends to be much more stable and consistent than the stock market and grows at about 5% before inflation. So we're going to use 5% GDP growth in our forecast. The S&P 500 is a lot more volatile than GDP. We can see that from 2000 to 2013, there was no return on the S&P 500 from price, but the last decade plus has been an incredible return experience. In our forecast, we're going to use a range of return assumptions and then take a look at what is most realistic given how high the valuation is on the stock market currently. We'll start our forecast with a simple repeat of the last 10 years of returns for SPY, 12.77%. We're going to grow GDP by 5% and see where we are in 10 years. In 10 years, the S&P 500 market cap would be 150 trillion if we repeated the last 10 years. And GDP, if grown at 5% over the next 10 years, will be 46 trillion. That would result in a market cap to GDP of 326%. Not realistic, in my opinion. So right away, I think we can rule out a repeat of the last 10 years. The next 10 years returns are probably going to be a lot lower than what we've seen in the last 10. What if the S&P 500 were to return 10% over the next decade and GDP were to grow at 5? Well, in 10 years, in 2034, we would be at $117 trillion market cap for the S&P 500, and GDP would still be at 46 trillion. That would be 254% market cap to GDP. Also a stretch, in my opinion. So we need to lower our return expectations even further to get a realistic outcome. If we get 7% growth in the S&P 500 over the next 10 years and 5% GDP growth, then by 2034, the S&P 500 market cap will be 88 trillion relative to a $46 trillion economy. That would be 191% market cap to GDP, still above where we're at today. Also, in my opinion, not very realistic. So what if we lower returns even more to 5% for the S&P 500 over the next 10 years and 5% top-line GDP growth? In 10 years, we'll be at $73 trillion S&P 500 market cap, and that would be 159% market cap to GDP, roughly where we're at right now. And I think this is the most realistic return forecast over the next 10 years. The S&P 500 price graph has a very easy to identify pattern. Bull markets, the green arrows, eventually give way to bear markets, the red arrows, and then go back to bull markets, so on and so forth. At the end of bull markets, the market cap to GDP ratio tends to be over 1, like it was in the year 2000 before the 13-year bear market, and like it is right now, where we are 160% of market cap to GDP. The most likely course of action over the next 10 years is going to be lower returns for the S&P 500 and likely a period of stagnation in the stock market while valuations revert back to the mean. Now let's take a look at one other element that I think can weigh down the returns for the S&P 500 over the next 10 years. Now this doesn't mean that you can't make money. I just think that the returns are likely to be a lot lower than they were in the last 10 years. And that element that I'm referencing is the Magnificent Seven. I think these stocks are in bubble territory, or at a minimum, very overvalued. They're very expensive, and they can hold the returns of the S&P 500 back as we go forward. Let's take a look at some numbers to support this idea. The Magnificent Seven stocks, which I have listed right here, are an incredible 32% of the S&P 500. They have a tremendous influence on the SPY ETF. These stocks are the most concentrated that we've ever seen in the history of the United States, far worse than the year 2000, for example. Apple alone is 12% market cap to GDP. The stocks as a group are 52% market cap to GDP. So I think their returns are limited as we go forward, and they're going to slow the S&P 500 down. The stocks as a group trade at a very low dividend yield of only 0.42%, and their PE is 40 times as a group. It's 40 times earnings, very expensive. The S&P 500 is at 26 times earnings, but these stocks are 1.5 times more expensive than the S&P 500, and they only provide 1/3 of the cash flow. Again, if these stocks slow down or get into trouble, it's going to be like an anchor on the performance of the S&P 500. So let's sum it all up. SPY is very expensive on a market cap to GDP basis. SPY is heavily influenced by a small number of very expensive stocks, and SPY as a whole is not cheap at 26 times earnings. Therefore, going forward for the next 10 years, I would expect single-digit return numbers and not double-digit return numbers like we've seen for the last decade. You're probably going to see returns somewhere in the 5 to 7% range. That's a lot more realistic than returns north of 10% for SPY. I hope this video was helpful. I hope it gets you thinking, helps you better analyze your investments, and overall improve your family's financial plan.